Hello everyone, welcome back to our channel. Today we have an exciting topic to dive into.
All right, let's talk about one of the most exciting and, let's be honest, one of the most dangerous setups in all of trading, the breakout. Today, we're not just going to talk about it, we're going to build a rock-solid, step-by-step blueprint to help you actually master it.
You know that feeling, right? You've been watching the price just bang its head against the ceiling over and over. And then it happens. A massive green candle just explodes right through it. Your heart starts racing, the adrenaline hits, and you think, this is it. The rocket ship is taking off and I am getting on. You smash that buy button.
But then, the worst feeling. Just as fast as it went up, it comes crashing right back down. Your stop loss is obliterated, your account takes a painful hit, and you're just left there staring at the screen thinking, what on earth just happened? Well, my friend, you just got caught in a classic trap, the fake out.
Now, if that little story felt a bit too familiar, I need you to hear this. You are not unlucky. This has nothing to do with bad luck or bad timing. It's about not having a professional process. And the good news, we can build that process right here, right now. This is it. This is the whole system, just 5 logical steps that will completely change the game for you, turning trading from a stressful gamble into a repeatable, professional process. We're going to walk through detection, confirmation, entry, your stop loss, and of course, setting a profitable target. Think of this as your personal filter to weed out all those nasty traps. So this entire system we're about to build is designed to defeat one specific enemy, the fake out. You know, that moment the market dangles a huge move in front of you, sucks in all the hopeful buyers, and then just pulls the rug out from under them. Let's break down exactly how to see it coming and avoid it.
Okay, our first 2 steps, this is all about preparation. This is the critical homework you do before you even dream of clicking that buy button. Honestly, getting this part right is more than half the battle.
So, step 1, detection. Look, a professional doesn't just scribble random lines on a chart and hope for the best. No, they're looking for a very specific type of resistance level, one where you can feel the pressure building. It's like finding a ticking time bomb that's just waiting to explode to the upside.
And there are 3 non-negotiable rules for finding one of these levels. First, it has to be super obvious on a higher time frame, like the 1-hour or the 4-hour chart. If you have to squint to see it, it doesn't count. Second, you need at least 3 clear rejections off that level. You see, 2 touches could just be a coincidence, but 3 is a real pattern. And third, and this is key, look at how the price is approaching that ceiling. You want to see compression, a series of higher lows getting squeezed up against that resistance. That's the visual sign of immense pressure building up.
Okay, I need you to pay really close attention here. This next step, step 2, confirmation. This is where I'd guess 80% of traders lose their money. It's the moment you have to learn to separate a genuine, powerful move from a very expensive fake out.
So what's the first rule of confirmation? It's simple. A long, skinny wick poking above the line means absolutely nothing. That's a fail. A wick just tells you that buyers tried to push through, but sellers were strong enough to slam the door in their face. What you need to see, what you have to wait for, is a big, solid candle body closing firmly above that level. That is the only signal that tells you the buyers have actually won the fight and are in control.
And rule number 2 for confirmation is all about the fuel for the move. Just think about it this way. A breakout without a huge surge in volume is like a car trying to drive up a really steep hill without any gas. It might lurch forward for a second, but you know what's going to happen? It's going to roll right back down.
So you need to see proof of that fuel. At the exact moment of the breakout, you want to look down at your volume indicator and see a massive green bar, one that absolutely dwarfs the last 10 or 20 bars. That huge spike is your evidence that the big players, the institutions with the real money, have just entered the building. And that's the power that makes a move last. Okay, deep breath. Our pre-trade checklist is done, we've found a great setup, and we've confirmed it's the real deal. Now it's time for execution. Steps 3, 4, and 5. This is how we manage the trade. When it comes to your entry, you've basically got 2 choices. The first is the momentum entry. This is where you buy the split second that big breakout candle closes. It's aggressive, and yeah, you can catch some really fast moves, but it's definitely higher risk. The professional's choice, more often than not, is the retest entry. This is where you patiently wait for the price to pull back, touch that old resistance line, and prove that it has now become a new floor of support. When it bounces off that level, that's your golden ticket to get in.
All right, step 4 is what keeps you in business, the stop loss. And we don't just throw it on the charts anywhere. We need to place it strategically to give ourselves a margin of safety that protects us from all the random, noisy market moves. So here are the rules. First, do not, I repeat, do not place your stop loss right under the breakout line. That's the most obvious spot in the world, and it's practically a target for market makers. Instead, you do place it below the most recent swing low, the little dip that happened right before the big breakout. That gives your trade a real structural buffer zone. It gives it room to breathe. Using a tool like the ATR indicator can also be a huge help here. Now let's talk math, because professional trading is a numbers game. And the most important rule of all is this. You only take trades where your potential reward is at least 2 times bigger than your potential risk. That's a 2-to-1 ratio. So if you're risking $100, your target has to be for at least a $200 profit. This is not a suggestion, it's a non-negotiable rule. And that brings us perfectly to our last step, number 5, setting that target. So how do we find it? It's actually super simple. You just look to the left on your chart. You scroll back and you find the next obvious area of resistance, the next hard wall where sellers are probably going to show up again. That area is like a magnet per price, and you want to set your take profit order just a little bit before price gets there, just to make sure you get paid. So when you put all of these 5 steps together, what have we really done? We've fundamentally transformed trading. We've taken it from an emotional, gut-wrenching gambling activity, and we've turned it into a calm, logical, repeatable process. And this table right here says it all. It's the whole mindset shift. The gambler jumps in on pure hope. The professional waits for cold, hard confirmation. The gambler sets a stop loss that's way too tight, or even worse, doesn't use one at all. The professional sees it as a simple, planned business expense. The gambler gets greedy and hopes for the moon. The professional sets a target based on math and what the market is actually telling them. And I really want to leave you with this one final thought, because it's so important. Getting stopped out of a trade does not mean you are a failure. If you followed your system to the letter, then a stop loss is nothing more than a calculated business expense. It's the cost of doing business that protects your capital and keeps you ready for the next great setup. It is what ensures you are here to trade again tomorrow.
இந்த வீடியோ உங்களுக்கு பிடிச்சிருந்ததுன்னா லைக் பண்ணுங்க, ஷேர் பண்ணுங்க, சப்ஸ்கிரைப் பண்ணுங்க. Thank you for watching.